On today's August 25 market tape, Wall Street staged a cautious rebound ahead of tomorrow's pivotal Nvidia earnings report. The S&P 500 gained 0.32% to close at 7,677, while the Nasdaq Composite rose 0.66% to 26,151. Behind this bounce, institutional positioning data from Citi reveals that traders have actively trimmed their S&P 500 and Nasdaq futures exposure back to neutral. Money managers are taking risk off the table to avoid getting caught on the wrong side of Wednesday's Nvidia release and Friday's Jackson Hole address by Federal Reserve Chair Kevin Warsh. Meanwhile, 10-year Treasury yields eased 6.5 basis points to 4.638%, driven by a pullback in crude oil prices. Looking across major indices, technical support levels held firm during Tuesday's session. The S&P 500 bounced directly off its 50-day moving average, signaling that institutional buyers are willing to step in during pullback dips. The Dow Jones Industrial Average also added 0.30% to finish at 53,577. Lower oil prices provided relief to corporate borrowing expectations, allowing bond yields to pull back after 2 consecutive sessions of upward pressure. That yield drop helped growth and technology stocks regain their footing. All eyes on Wall Street are fixed on Nvidia's fiscal second quarter earnings report, scheduled for release after Wednesday's market close. Nvidia shares climbed 2.2% on Tuesday, as investors positioned for what is widely viewed as a test for the broader AI market rally. Options pricing indicates an expected post-earnings stock move of roughly $12 per share, or about 5.6% in either direction. Wall Street consensus projects 97% year-over-year revenue growth and a doubling of earnings per share. However, analysts note that with high expectations already baked into semiconductor valuations, even a solid beat could trigger short-term profit-taking if guidance fails to surprise. New positioning flow analytics from Citi confirm that global equity inflows slowed significantly over the past week. Traders have systematically unwound long contracts in both the S&P 500 and Nasdaq, moving net exposure back to historical neutral levels. The notable exception is small-cap equities. Long exposure in Russell 2000 futures remains near a 3-year high. That concentration makes small caps vulnerable to sharp profit-taking if macroeconomic data or Nvidia guidance disappoints the market later this week. Treasury market dynamics are being shaped by Treasury Secretary Scott Bessent's debt management strategy. Financial analysts at Sunny Financial Commentary note that Treasury's ongoing strategy of selling short-term T-bills to fund long-term bond buybacks functions as implicit yield curve control. By absorbing long-term Treasuries from the market, Treasury is attempting to place a ceiling on 10-year and 30-year yields. However, macro research from 42 Macro indicates that 10-year Treasury nominal fair value sits around 5.77% across 5 independent valuation models. This gap suggests structural upward pressure on yields persists despite government buyback intervention. Treasury's strategy of shortening average debt duration creates friction with Federal Reserve monetary policy. Shortening maturities leaves Treasury debt servicing costs increasingly sensitive to short-term interest rates and the Fed's overnight rate. Macro Voices analysis highlights that Fed Chair Kevin Warsh's nomination was intended to support the U.S. dollar and anchor long-term inflation expectations. As Warsh prepares to deliver his first Jackson Hole address on Friday, the interaction between Treasury debt issuance and Fed rate policy remains a primary focus for institutional bond desks. Fresh macroeconomic data released today highlights growing pressure on the American consumer. The Conference Board's preliminary Consumer Confidence Index for August fell to 89.4. More concerningly, the Expectations Index plunged to 68.2. Historically, readings below 80 signal an impending economic contraction. In addition, 61.3% of surveyed consumers expect interest rates to rise over the next 12 months, reflecting persistent inflation concerns despite slowing job growth. The shift in consumer behavior is forcing major retailers into aggressive price competition. Walmart announced price reductions on 11,000 items, double its typical discount volume, following its weakest 6-year sales growth pace. Meanwhile, Dick's Sporting Goods stock dropped 27% after management warned of a promotional environment in footwear and lowered full-year earnings guidance. Retailers are sacrificing gross margins to protect unit sales as household discretionary spending contracts. Trade tensions escalated today following the breakdown of bilateral trade negotiations between the United States and Canada. Ottawa announced 50% retaliatory tariffs on 700 U.S. product categories to target U.S. steel, aluminum, and agricultural exports. This move follows recent U.S. tariff increases and adds cost pressure to cross-border supply chains. In precious metals, institutional options activity points to a pause in gold's recent rally. Institutional flow tracking reveals a $58 million net credit call spread executed on the GLD ETF, using 420/430 strike calls expiring in mid-September. This large-scale options trade effectively bets that gold prices will remain capped below key resistance levels over the next 3 weeks as real yields stabilize. In corporate earnings, Latin American fintech leader Nubank reported Q2 2026 GAAP net income exceeding $1 billion, up 49% year-over-year. FX-neutral revenue rose 39%, while gross profit surged 43%. Analytical coverage by Daniel Pronk highlights Nubank's operating leverage. Monthly average revenue per user has expanded 418% since late 2020, while the average monthly cost to serve each active customer dropped 9% over the same period. Across individual equities, small-cap infrastructure provider Limbach designated 2026 a full reset year as Q2 gross margins compressed, delaying margin expansion targets to 2027. Concurrently, Interactive Brokers broke out of a technical consolidation base today, surging 5.5% on above-average trading volume. Robinhood also flashed a technical buy signal as retail trading activity expanded ahead of Nvidia earnings. In summary, institutional capital has moved to a neutral stance ahead of Wednesday's Nvidia earnings and Friday's Jackson Hole address. While Treasury's implicit yield curve control provides a short-term cap on long-end bond yields, structural inflation and fiscal deficits mean rate volatility is here to stay. Investors should remain selective, focusing on companies with demonstrated operating leverage and resilient balance sheets.